Good afternoon. Good afternoon, and welcome to PE and Alt Assets in a 401k. Good for retail investors. We've got excellent speakers here this afternoon. We are going to hear from Ben Edwards, Associate Dean for the Faculty Development and Research at University of Nevada, Las Vegas, William S. Boyd School of Law. And he is also a law professor researching and writing mostly about corporate and securities law, legal ethics, and the regulation of financial advice. And we also have Alexander Platt from the University of Kansas School of Law. And Mr. Platt is an expert in securities regulation. His articles have been published by the Standard Law Review and other leading journals. And before joining KU, Mr. Platt was a Kelemenko Fellow and a lecturer on law at Harvard Law School. And we expect to have James Watkins, who is CEO and managing member at InvestSense LLC. He also is an attorney, and Mr. Watkins is the founder and CEO of Investments and Sense and provides fiduciary prudence and oversight and compliance services. He is a fiduciary forensics expert and a fiduciary litigation and risk management expert. And I'm Kate McBride. I'm an ERISA 402A fiduciary specialist at Fiduciary Wise and a member of the U.S. Department of Labor ERISA Advisory Council. So why don't we just jump in? Uh, 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 One thing struck me on the way into to talking about this, and that is that ERISA 404A1A says that a fiduciary should discharge their duties with respect to the plan solely in the interests of participants and beneficiaries for the exclusive purpose of providing benefits to participants and their beneficiaries and defraying reasonable expenses of administering the plan. And they should do this with the care, skill, prudence, and diligence under the circumstances then prevailing that a prudent person acting in a like capacity and familiar with such matters would use in the conduct of an enterprise of like character and like aims. So that means the plan participant comes first, no matter what. So the question is, how does private equity or other private non-traded assets, how do they fit into a 401k plan, and do they belong? Who would like to jump in on this question? Ben, do you want to go first?
Oh boy. Well, I mean, here I think it really depends when you're uh, what you're talking about when it comes to retail investor or plan participant exposure to private assets. There are many different ways that retail investors might gain access to some private equity products or invest in private equity funds. They are not all created equal. And there are often substantial differences in terms of fees, liquidity, time horizon, the experience of the advisor, the resources and track record of the private equity firm. And so I don't want to say out of the box that retail investors should never have any access to private markets. But at the same time, I do think there's good reason for us to be thoughtful about how that access occurs and how we think about this. If we're looking at it strictly from the perspective of a plan administrator, as to whether or not they would be able to add these kinds of products to their menu of options, I think those are questions they're going to have to grapple with and think about. But I think retail investors are going to be getting access to these products and already have access to these products in many ways outside of a retirement plan that's covered by ERISA.
So, Alex, what do you think about this? And do these kinds of non-traded, non-publicly traded, non-publicly priced assets belong in 401k plans specifically?
Well, I think to back up, it's useful to think about how we got here, because I think there's an air of inevitability about this, um, which comes from the fact that for decades now, private markets have been expanding, growing. We have these enormous, mature, sophisticated firms who are staying private longer I saw one industry report I read recently said that 80% of firms that are valued over $100 million are private firms. So that tells you that an awful lot of economic activity, investment activity has moved over to the private markets. And it's not just dollar amounts, it's also the way those markets are operating has changed. We have an institutionalization of the investors in that market where we have these enormous private equity firms who are themselves, in many cases, publicly traded. We have venture capital firms who are enormous and well established. And I think also you keep referring to these investments as non-traded, but increasingly that is murky. There is an increasing amount of secondary trading, resale activity in private markets over the last few decades. So if you take all those changes and put them together, what you have is just enormous pressure on the regulatory system, which traditionally has kept out the vast majority of people from private investments. And as the private market grows and overtakes, even in some cases, the public markets and the regulatory system continues to keep those people out, there's just an awful lot of pressure that builds up. And so it's really not surprising and maybe even inevitable that that pressure forces a change in the regulatory system to accommodate a change in the market, a change in the underlying economy. And I think actually that's what regulatory systems should do. They should change when the underlying economic reality changes. They should not just stick to the way things used to be, the system, the way it used to be, ignore what changes. Of course, they should adapt and change. Now, lots of good questions can be asked about, how to go about this, how to balance the different interests. But I think, we have to begin by recognizing this is not just um, a free, out of the blue policy choice. It is, I think, really something that was a long time coming and comes from a reaction to changes in the economic reality. So that would be my first statement. I'll say one more thing and then I'll kick it back to you. We have a really another piece of the big pressure, I think, that is forcing this change comes from the fact that there's this enormous asymmetry in the way retirement savings has had access to private markets. So we have defined benefit plans, pension plans, which allocate, I think, on average, like 25% to private equity or similar things. And then the defined contribution plans, which is what we're talking about, 401(k) plans,
Mhm.
close to 0%. So
Mhm.
you could have, and you do have today, a situation where imagine there are two workers, two employees, same field, same salary, same everything, except that one happens to work for a firm with a defined contribution plan and the other happens to work for a firm with a defined benefit plan. And their retirement portfolios are enormously different.
Mhm.
One has 25% in private markets, one has 0%. So that doesn't really make a lot of sense. I think that adds to the pressure on the regulatory system. Something has got to give. And so here we are at the moment where things are starting to give. And I'll just echo Ben. I mean, these are early days.
Oh, yes.
There's not a lot of detail either on the regulatory legal side about what this is going to look like or on the business side. Like what are these products actually going to look like? Those are starting to take shape, but not really. So it's a moving target for us to discuss, but I think we can have a good high level general conversation about it.
Yeah.
So
And
what
if
about
I
the plan
can,
participants? Oh, yes, Ben, jump in.
I jump in with just a little statistical information here. about the changes and the pressure that's built up. So, my review, Regulation D offerings or private offerings raised about $588 billion in 2009. Uh, 15 years later, in 2024, they raised about 2.15 trillion. And so the inflow of assets into private markets has been huge, and part of this has just been, our definition of an accredited investor has not been indexed for inflation, and so more and more Americans are being treated as accredited investors or becoming accredited investors, just because of inflation or because they hold assets in a defined contribution plan, and so that's personal wealth that will count for that versus having a defined benefit plan, which isn't counted the same way. Um, but if you're looking at the overall, size of the private funds market right now, it's about $24.3 trillion in assets as of 2024. So I mean, these markets are large, and they're significant. So I think thinking about how to manage access or um, how to ensure that retail investors get a fair shake is absolutely worth doing.
Well, I agree on the fair shake part, I think, but I approach it from a different angle, I think. Um, these assets have been for the very, very high net worth traditionally. And I wonder, how is it that plan sponsors can feel comfortable selecting something like this that is not generally traded the way that mutual funds and stocks would be in a plan? That an investor in a 401(k) can't just type in a sell order on PE and have it, gone and plus two or whatever. So how would that work in terms of investors? And another question that goes with this is, most investors in 401(k) plans, well, first of all, pension plans and 401(k) plans couldn't be further apart in terms of management. Pensions are managed by investment professionals with a lot of help, and 401(k) plans are not. There may be a 338, there might be a 321, but there's not a manager of the money in that pension the same way, in a 401(k), the same way that it is in a pension. So how do regular 401(k) investors know what to invest in or not when it comes to private equity? Because they really don't have any idea that this is not something that is traded on exchange necessarily. In other words, there's not a level of professional knowledge that is high enough to really make that kind of decision by the normal average 401(k) investor. So why would private equity be in a plan like that, a 401(k) plan?
Okay, so I'll jump in here and sort of at the outset, I want to drop a quick note on terminology because often people use different terms. Both defined benefit pensions, which is what people usually mean when they say pension, and I think that's pretty clear.
Hmm.
But a 401(k) plan is a pension. It is a defined contribution pension. And so the way I think about this is if we're looking at what should be available within a defined contribution pension, you've got, I think, some obligation. And I'm not an expert on ERISA law, so here I want to be very careful because I did not prepare to give any kind of opinion on exactly what plan sponsors of defined contribution plans need to do from a diligence perspective before adding a private equity option, to the plan. But if they're going to do that, my recommendation would be that they need to be reasonably comfortable in the way they're adding it, and also in the conditions under which they allow access and the percentages they allow access. I don't have strong views right now on exactly what those need to be, but the reality is, I think if a plan sponsor is not um, doesn't have any basis for feeling like it's a decent option to put on the menu, I would just not put it in there.
So I have a different answer. And it I think the most popular class of investing for 401k plans, I believe this, are target date funds. If not the most, certainly one of the most common. Um,
Yes, it is. It has had the most uptake.
Most uptake. What are target date funds? These come in different flavors, but they're basically set it and forget it mutual funds where you choose your retirement date and the fund manager, maybe it's BlackRock, maybe it's State Street or T. Rowe Price or somebody, Vanguard. What they do is they, according to a mechanistic system, adjust the allocation of your portfolio over time so that it starts off with more equity and then gradually shifts to fixed income as you get closer to retirement, something like that. Um, so that's the most important, I think, class of investing that happens in 401k plans, or one of the most. And I also think that is the place we are most likely to see private assets start creeping in to 401k plans. It's not from the plan sponsor adding some random private equity fund. Rather, it's BlackRock adding a slice of private assets to its target date fund. It's State Street doing the same. And that, I think, is the best way. If we're going to do this, I think that's the way to do it. This is kind of what the SEC's Investor Advisor Committee just said. They put out a report in the last week or two
Hmm.
saying, look, uh, we're not saying we're thrilled about this change that we're seeing moving towards more retail access to private markets, but if it's going to happen, it should happen through registered funds. And
Hmm.
that's exactly what the target date funds are. And, to your point, Kate, I take the distinction that defined benefit plans are managed by financial professionals where 401k plans are not. But the management and the intermediation is happening by the target date fund manager, BlackRock, State Street, Vanguard, T. Rowe Price. They are the intermediaries who are standing between the retirement saver and these private assets. And they are making the allocation choices so that it's not really in the power of me or some retiree or worker to say, "Oh, I wonder about this private company or this private fund." No, you're in the BlackRock. I'm picking on BlackRock just randomly. You're in the T. Rowe Price target date, 2056 retirement fund, which you don't even know what's in there. You're just saying, yeah, whatever, that sounds good. Turns out to have a 5% allocation to some private credit, some private equity, who knows what else. That's part of its mix. And T. Rowe Price is managing that. So before this event, I did some looking around to see, who's out there talking about this. And the
Hmm.
ones I've mentioned have. So State Street has already rolled out something like this, a target date fund that is a partnership with Apollo, where
Hmm.
there's part of the target date fund's allocation is to the State Street Index Fund, to the State Street Bond Fund, and then a piece of it to whatever Apollo Private Credit Fund is in there. T. Rowe Price has a partnership with Goldman Sachs to do something similar. BlackRock is doing something similar. Um, and I think this is great for several reasons. I mean, it's great within the context of this discussion. Number one, um, the people I just mentioned, State Street, BlackRock especially, what are they associated with? They're associated with low costs. So they are trying to do diversification and keep those costs low as far as possible. And so I really have a hard time imagining that care for diversification and low cost is just going to disappear overnight because they've added a 5% allocation to private markets? I don't think so. I think that is going to continue to be a driving force of competition in this market for target date funds. Second, I left some people off the list. So there are some of the big asset managers who have been slower. I think noticeably slower to jump on this bandwagon. I'm thinking about Vanguard. I looked around, didn't see any mention of Vanguard target date funds looking to add private assets. Fidelity too. Although, don't take my word for it. This is just me Googling. But the point is that we have already something that looks like a split among the largest target date fund managers over how eager they are to rush into this. And I think that's good because it's going to show there's going to be some testing, there's going to be some competition, there's going to be some trial and errors. How are we going to handle the liquidity issues? How are we going to handle keeping fees low? And I think that is what we want. After all, why do we have index funds today? Why do we have the super low cost, diversified access to the whole market? It's not because of some regulatory fiat. It's because companies like Vanguard and State Street and others were innovating and eventually convinced a lot of people that actually we can save on fees and get a whole diversified access to the market. And I think that's been really good for retirement savers. And I think this could be another step in that direction, or not, but the competition should be allowed to play out. And I think it'll be interesting to see how it all shakes out.
Hey,
Thank
do you
you.
want to jump? Do you want to jump in there because there's so much on the table that Ben and Alex have put out there. I want you to get first dibs, but otherwise I will jump in after you do.
All right. Well, I just I think aside from the fact that these are so opaque, even if they are added to target date funds, that there is a little bit of a blind spot, and I don't know how plan sponsors would feel about that blind spot with the lawsuits that are going on now, and how Schlichter was in the Wall Street Journal yesterday or the day before, talking about, the administration. This is the quote. This is a quote. I'm not saying this. This is from an article in the Wall Street Journal 2 days ago, and it says the administration won't be able to give employers total immunity, legal experts say, casting doubt on how quickly companies might feel comfortable including higher priced assets like private equity in 401k plans. So that's one question. Another question is, how are these valued? And how in other words, how are these valued when they go into a plan, and who's doing that valuation? And well, so let's just pick that apart for a moment.
Can I just say the litigation question I think is really open. How much can the Department of Labor even do on this? I think is like a kind of fascinating legal question that remains to be seen. Will Congress have to act to provide a statutory safe harbor or something like that? Or can the Department of Labor do that itself? I don't know the answer to that. They will certainly try. It does seem likely that that is what they are trying to figure out. They'll put something out there, regulation, and then it'll be subject to some kind of testing in court. So that's one thing. But I think assuming there is litigation exposure here, and assuming fees are a big piece of the puzzle, I thought it was really interesting that the Wall Street Journal recently, I think maybe in the same article or another recent one, reported that one of these target date funds, I forget the name of it, but one of these target date funds that's forthcoming next year will include some private equity and private credit exposure. And the manager estimated the average fee to be 38 basis points.
How can a
38
plan sponsor put that into a plan?
a 38 basis points for the whole target date fund. That's the fee structure. So from my perspective, 38
For the
basis
whole fund,
points,
not for that one sleeve.
38 basis points all in. That's your 2065 target date fund. And that's going to include, mostly equity index fund, a little bit of bonds, and then some private assets. And all told, 38, that's the Wall Street Journal reporting. That's the estimate. Now it remains to be seen if that's true. But to me, so that's higher. 38 basis points is a little bit higher than, the Vanguard or the low cost index fund target date funds. But it's, I think, well within the range of many of these target date funds that don't have any private assets. So somehow, like I don't know how they're doing it, but somehow this serious player has announced that they expect to do this at an economy of scale, which I think is plausible. I mean, think about how enormous some of these players are, BlackRock and State Street. Um, so they have some kind of leverage to do this at scale. Look, I don't know. I mean, I'm not, I think we don't, nobody knows because these things haven't been rolled out yet. But 38 basis points is not, 2 and 20, right? I mean,
Well, yeah.
that's a,
So I kind of feel like that. I don't know. I guess I have to explore that more because I did not see that, and I kind of don't really see how that's possible. But that's a very interesting. That's very interesting. I mean, Ben, have you heard that as well? I have a hard time wrapping my
I
head
have
around that.
no reason to doubt, the figure. And when you're thinking about the size and scale of some of these funds, they have capabilities to do things that offset fees sometimes. For example, some funds might allow a portion of their shares to be used for securities lending or other things.
But that
Uh,
doesn't go. That doesn't bring 2 and 20 down to 38 basis
Well,
points.
they're
But
not looking to charge hedge fund fees,
yeah.
these kinds of products to begin with. But
Uh,
if they're looking to operate at scale and cost is a material factor, which it always is, keeping those costs low
uh,
uh, really allows them to just expand the scale of the operation in a way that maybe like obviously the creators of the funds like money, and they want to be paid, but you may get paid more by getting bigger at a really low rate than staying smaller and charging a higher percentage. Particularly if you're not doing any really complex asset allocation work that would justify the cost. If you can largely automate it and index, most of it, I understand how the cost can get pretty astonishingly low. So I want to sort of echo again, if it's, I'm much more nervous about individual retail investors picking individual business development company, offerings. I'm less nervous about registered funds. I think I tend to agree with the SEC's Investor Advisory Committee that is meeting today, that the preferred route for this is going to be through registered funds, and the hope is your defined benefit pension plans, you have the real benefit of uh, experts making the portfolio allocation decisions, and so if we're going to be able to recreate some of that expertise in a way that makes sense and at reasonable cost through registered funds, I think that's great. But to sort of segue on, you're right that there are going to be real valuation challenges. And so a lot of times you're trying to figure out, well, how are they valuing these? That's one of the things that the SEC's Investor Advisory Committee is also concerned with. There's not a whole lot of transparency on how valuations are done. And right now, a fund may have a board of directors, and the fund is often going to have an advisor that's managing the assets and reporting to the fund. Now, if the advisor is also providing the valuations, to the board, and the advisor is being compensated on assets under management. there's a conflict there. And one of the things that the SEC recommendation calls for is to make rules such that if the advisor of one of these funds has rejected some other valuation, that maybe they had a third party do a valuation, it came in lower than they thought they would like, and so they adjusted the valuation for whatever reasons, that the board has to be informed about that. And I would probably go farther, and I might want that to roll into some kind of public disclosure. But the valuation issue I think is real, and when you have private market assets where you have a lot of different people often valuing the same asset. A good example I think was shares in Uber before it went public, where a number of mutual funds and others held that. They all had different valuations. And so, it's hard to say whether any one of them was right. But I mean, the challenge, I think, for retail investors, if they have direct exposure and they have direct substantial exposure, is going to be understanding that there may be a range of uncertainty around a asset valuation. And if you have a clear brokerage statement that gives you a number, it may not always communicate the true range of uncertainty. But if your access is through interval funds or sort of retirement target date funds, where you're going to be out of private equity, you would think 15, 20 years before you reach that date, and you're not touching the funds before then. Maybe it's less of an issue that's going to contribute to volatility.
Okay. This is where I got to jump in, guys. I've really enjoyed listening to the picture that you have painted over the last 20 minutes. And the picture, as I understand that you understand, it's all about the change in the marketplace. And what you haven't said, but I think is implicit, is that it's not just the change of the marketplace, it's the change in the supply in the marketplace for these funds.
Thank you.
Nobody's even mentioned the fact that, notwithstanding some claim from some private entity that there is no market demand for these funds, and maybe there's no market demand for these funds because if they knew what they were getting into, they wouldn't come close to it. Now, I'll give you plenty of chance to come back and tell me why I'm wrong on that. But I'm just getting warmed up, guys, because I did not hear once in either of your presentations a mention of the F word. I didn't hear once a mention of who is the typical 401k plan participant. Who is he? Who is she? And guess what? And does that person actually rely on their 401k to fund their retirement? When I get into these conversations before, I've asked advisors directly, have you ever met a client who is actually reliant on their 401k? So far, I've yet to get one advisor who has said yes. So, okay, let's just pause there for a second. If we want to talk, we've talked about 401ks, we've talked about other retirement plans, we've talked about, on the institutional side. I would hope that we could agree that retail investors might be treated differently than institutional investors. I would hope further that we would agree that where should be the safest place on the planet for a retail investor to put their funds. It should be in an ERISA account.
Yeah.
I would think we might agree on that. So I think of these things and say, what the heck are we getting? Are we going along just to get along because it is inevitable, because the market forces are there? And I understand that this has been building for years. I understand that it wasn't all of a sudden on January 20th, 2025, that all of a sudden there was a big surplus of these private equity and all. I get that. But guess what happened before then? Guess what happened at the SEC? Okay. Oh, well, that's a regulatory issue, Knut. No, it is not just a regulatory issue. It is how our system has developed and supposed to work in the area of how much investor protection is applicable, how much is appropriate. And so, why son of a gun on January 21st, all of a sudden, Washington goes haywire because guess what? We're going to make it easier for alternative investments to get on 401ks. Okay, so now my next question is, would somebody here explain to me why we've had it wrong up until now? Because either one, and explain to me why we even need the executive order. And the executive order does what? It has ordered the Department of Labor to change the rules, adjust the rules, add guidance to make it easier for plan sponsors to feel comfortable accepting alternative investments. And then what's the other side of it? The other side of it is, oh yeah, and we've also got to have the Department of Labor make it harder for plan participants who have been wronged to go after them in court. We've got to make it harder to challenge them legally. So
do you want to talk about the motivation there and why that's the thing now?
Well, no. I'm just talking about this picture that I've seen painted here and saying, what land are we living in? What world are we living in? Now, in terms of just forgetting this thing called fiduciary, and what is the name of this group that is putting on this program today? And so it's not even a factor. It's like you go back and you read that infamous article of 20 or 30 years ago, the marketplace for lemons, Kate, which you will remember probably. Well, it is a classic article about how it is that less desirable products can move in the marketplace. So it is the market for lemons. Anyway, so I'd like at a high level, and this is not a matter of being an expert on ERISA or an expert on what's left of the fiduciary standard at the SEC. This is a matter of saying, to me, how do we address the fact that these are more complicated, these are more expensive, these are more opaque products that we're talking about, and that it seems that in concept they've told Jack Bogle to go take a walk because they're everything that he wasn't, that Vanguard used to be for. So okay, I'm going to pause now and give you guys as much time as you want to reply, but it comes down to, what are we supposed to tell the plan participant who actually relies on his 401k plan when things don't go right because of all the concerns that people have? And then finally, tell me how is it that a guy like David Swensen got it all wrong? And he got it all wrong because what did he say? Again and again and again. Retail investors
index funds for retail investors. Period. Yeah.
Period. Okay. Yeah. All right. I'll stop now.
All right. Who wants to jump in?
Okay. Well, I'll go. There's a lot, and so I guess the first thing I want to start with is, we say there's no demand. They sold $2 trillion of Reg D offerings last year, and so if we say there's no demand, I'm not really sure what it means.
It means that these
they are
products
managing
are
to sell an enormous amount of these, and if there wasn't demand, they wouldn't be able to sell it.
And they're not bought. It's the difference between a product being sold as opposed to a product being bought. But okay, go on.
So sort of at the outset, there is, I think, a lot of people are buying it, and I see your point that when it comes to many of these products, if you're thinking about your ordinary retail investor, and you're looking at what the sort of median level of financial sophistication among Americans is with these products, I think it is unlikely that your average Joe is going to say, I would really like to buy shares of a non-traded business development corporation. And so those kinds of transactions, I think, you want to be suspicious about. And that's why we maintain a good deal of liability for investment advisors and others who are making recommendations. If they are recommending particular products that are not in the best interest of their clients and they're operating as brokers, there is regulation best interest, which does have its flaws, but does provide for some degree of liability. There's also a fiduciary standard for registered investment advisors who are giving advice about these products to their clients. And so I think they accept a degree of liability there. So one of the challenges is the conversation, I think, is moving in different directions to where if you're trying to understand the market and the rollout to retail investors, I think that's one discussion. If you're trying to decide when these financial advisors who are fiduciaries should be recommending these products to their clients or what they should be thinking about as a reasonably prudent way, to go about and do that. I think that's a very different conversation. I fundamentally disagree that a 401k is the safest asset thing that people should be holding. Because if you want to know what the safest is, it's going to be an FDIC insured bank account where you have a federal guarantee that if the bank fails and you hold less than $250,000, you can get your money back. So if you go beyond that, that's your 401k. That's where you're going to have capital that is at a degree of risk because you want a better return for your retirement
There
than
has to
what
be
you
an
would get.
appropriate amount of risk for sure. Yeah, I don't think anybody's
And so if you're trying to figure out, well, what
denying
is
that.
the appropriate amount of risk? How risky should these products be? I mean, the challenge here is you've got to give people exposure to risk. And within the public market, you have sort of, I think, a high degree of increasing concentration within public firms. We're at, a relatively smaller number of public firms than we've had in a very long time. The concentration within those firms has gone up. Their profitability has also gone up. So if you're looking at, well, what's the argument for why retail investors should have access to more private assets? There's really two, pieces of it. One is this fear that only the wealthiest people are getting access to the best opportunities and they're being locked out and left behind. And the other is simply that, with the size of private markets growing, and they have been growing, that if you want to have exposure to the full market and you only have exposure to the public market, you're missing out on the diversification benefit you would get, from private markets. So obviously, I think there's significant valuation challenges, and there are going to be issues, potentially for plan sponsors and for financial advisors that are making recommendations. I'm not going, I'm someone who talks to retail investors and I advise retail investors sometimes about whether or not to sue financial advisors. If there is a small portfolio allocation to a registered fund that holds some private assets and it is prudent given the size of the portfolio and the exposure, I think it's hard to say that they've made an unreasonable decision if they pick a high quality fund and the concentration level is not too high. I would never recommend that anyone, shift, an enormous amount of money that they're going to need in the near term where they have some liquidity need for it into these kinds of private assets. And I don't think anybody with any sense would do that.
Yeah, I'll throw
Thank
in.
you, Ben. Alex?
I think. Well, I don't know what the most productive way to intervene here is, but I would again commend to anyone interested in this topic the SEC Investor Advisory Committee report, which is on the SEC website, which I think takes an admirably moderate tone to this important issue. And it's compromise, it's moderation, it's we don't really like this, but if we have to do it, here's the least bad. I think that is a more productive way to engage in this kind of debate
Okay, well,
than
Alex, but you want a productive way to engage would be to address some of the concerns directly and substantively. That to me would be a good way to engage. And just to say that if you have to do it, okay, wait, pause. Who says you have to do it? I mean, seriously, this is not a
There's
rhetorical
nothing
question.
that says you have to do it. Nothing.
Thank you. Thank you.
We
So-
have a guest, Phyllis Borzi, has joined the call, and I would love to hear from Phyllis
Well, except that
about.
I haven't heard a word that anybody's said. I've just managed to get in now. So I
That's
don't,
all right. So
Well-
so we're discussing private equity in plants
Right.
and the pros and cons. And we have two academics here, Alex Platt and Ben Edwards, and of course Canute and myself. So I would love to hear your thinking on this proposal to potentially put in private equity in plants.
well, I find it very troubling. There is, as you said, as I came on, there isn't anything in ERISA that prohibits. ERISA is structured so that there are no lists. There's no good list, there's no bad lists. The whole structure of ERISA is a fiduciary in exercising his or her prudent judgment, decides which transactions to move forward on, which transactions not to move forward on. And so there's a reason that these are called hard to value assets. And that is that it's extraordinarily difficult for a fiduciary to make a judgment because there is no universally recognized objective, non-industry generated benchmark for performance. The studies that have been done, it's my understanding, are mixed at best as far as their performance. But they're generalized studies. And the one thing I do know, both from my private practice and my work in the government, is if you've seen one of these transactions, you've seen one of these transactions. They're not like off the shelf kind of things where people can say, there's been a study and people have looked at this and they all have these 5 characteristics. That isn't the way at least that's my experience. That isn't the way the marketplace works. And so it's extraordinarily difficult for a fiduciary to make the kind of judgment that ERISA's fiduciary standard requires. Not impossible, but difficult. Many of these private, and I'm going to focus on private equity. Private equity, these transactions are not transparent. There's virtually no disclosure, certainly not under ERISA. And so it's particularly difficult for fiduciaries to make any kind of reasonable decision in a target date fund world. And that's, of course, where the money is. So that's, of course, where the private equity people are owning in. Because once you get a foot in the door, even if you get a 1%, you're still getting $1 bazillion. And I would guess that if we did a survey, and maybe Ben, there might be some research about this, and Alex, you're a professor as well, right? So maybe you know some research about this. The most fiduciaries who reasonably and prudently select a target date fund as one of the investment options for the participants in the 401k have no idea what the underlying investments are within that target date fund. As a matter of fact, they may currently have private equity in there. They just don't know. And one of my biggest regrets when I was at the Department of Labor and we were working on the 408(b)(2) fee disclosure regulations is I tried very hard to incorporate a look through, a pass through for disclosure, that if you have a pooled fund, then you have to disclose not just the fees for the umbrella fund, but what the funds within the pooled program were, A, So identify them and what their fees are. And this is one in which I deferred, to my detriment, I am willing to admit, to the career people who reminded me, as if I needed reminding, having been in the private sector for many years, that the department had never taken a position that you looked through any of these. They had opinions on mutual funds, and they said you didn't have to look through on a mutual fund. And, my dad used to tell us when we were little, because we were a rambunctious bunch of kids. And his favorite saying to us when we were being overly rambunctious was, "You better pick the hill you choose to die on." And the career people said, we're taking on a lot here for some in the industry. Some of the industry supported it. Some did not. And so I decided that this wasn't the hill that I chose a different hill. I didn't die on it. I'll never die on a hill, but I did choose to fight on the basic fiduciary rule thing. And
So let me,
so
okay.
that's the difficulty from a very practical, personal, from my experience in advising fiduciaries and being even currently a fiduciary on funds. It's very difficult to even figure out what the underlying funds are or to make a reasonable judgment on performance. I'm sorry, I interrupted you,
So
Alex.
this is, I think, the tone of you're leading into something I was starting to say a second ago. This report from the SEC Investor Advisory Committee, I think this leads directly into that. So their take is if we have to do this, give retail exposure to private funds, we should do it through registered funds. And the reason why is because the current regulatory apparatus for registered funds already provides some and could provide more of what exactly you just said, Phyllis, which is more disclosure of what exactly is going on with these private funds that are now going to be part of the target date funds, as far as fees, as far as conflicts of interest, as far as valuation methods, as far as um, you know, other things that are going on in there. And I think that is correct. I think if BlackRock or State Street or T. Rowe Price are going to start putting private funds into the target date fund, which they already have, um, then those target date funds, which are registered, will have to comply with the fund rules of disclosure. And I think it's fair to say we should have a little bit more of that look through and tell us, okay, so you say that you're saying, like, I'm looking at this June 26th Wall Street Journal report that I referenced earlier, which says that the one of these entities, Great Gray, which is going to offer a target date fund with private credit and private equity, has an average of 38 basis points of fees. That's the whole fund. That's pretty low. So, but what I would wonder if I were a regulator is that real? Is that really the extent of the fees? Or are there other fees that are somehow being hidden in the private equity fund, that aren't being passed,
Right.
that are coming through
Yep.
as weak returns, but are really fees? And I think it's totally fair for a regulator to insist on, no, 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 we don't think you have done the right work here in telling investors what the fees are. We want all the fees. And I think that the registered fund apparatus is the correct way to do that. And I'll just throw in as a final rhetorical point, this is a kind of backdoor way to get what Gary Gensler tried and failed to get through the private funds rule a few years ago. A few years ago,
Yeah.
SEC proposed this rule, which is we want all these private funds to start telling everybody what their fees really are,
Hmm.
to tell us about their conflicts of interest, and that got struck down by the Fifth Circuit. And now, if
Go
all
figure.
these if all these same private funds, or many of them, are going to want to get a piece of what you just said, Phyllis, is this enormous target date fund pie, even if it's 1%, that's a huge, they
1%
want
is
it.
a big
1% of the target date funds, like, I would
Well,
take that.
I just read it that they expect $12 trillion in target date funds. 1%.
Yes. So that sounds great. But if that's now the carrot, then maybe what needs to happen is the regulators need to say, all right, you can come in, but if you're joining the registered fund community, that means you have to get serious about what your fees really are. You can't do this, oh, it's only this. No, tell us all the fees, including all the sketchy ones that you extract from the companies that you invest in. All the stuff Gensler was talking about, and I'm using him, but it was the SEC, of course.
Right.
Right.
And that private funds rule, those were legitimate concerns that become even more important now, if we are going to have these in registered funds. So I think that's the glasses half full take on what's happening here.
I,
Well, but does anybody think that in the next 3.5 years or whatever, we're ever going to see anything like that? Not me.
I don't think so.
If
I,
anything, we're
I
going
would
to
like to
see
see it,
a
but
safe
no.
harbor, which has
Yeah.
never been done. Never
Yeah.
in the 51 years that ERISA's been around, has there ever been a safe harbor for any asset class. That's what we're going to see.
Well, it'll have to be a safe ocean because a safe harbor won't be big enough. I,
Right.
I, I am struck by the issue of motivation and why private equity firms want to spread their seeds around further out from where they are. And it is a fact that private equity and some of the other private assets have not been doing well, and they are not getting taken public, and they are not doing the things that they normally would do in a strong market. And that is part of the motivation for putting them in other places and why they want to put them into this gigantic ocean of
Well,
uh, 401ks.
it's such an easy lift because they can sneak them in the target date fund and
Yeah,
nobody will know about it.
I think we have. I shudder to think that that would be the case, and I really that makes me very sad to think that they just may be mixed in without people knowing. But also working, in the industry with plans and plan participants, it is very evident that they will not know, and that is really a criminal thing. That
Well,
the
and if
fees
the
would get mixed in
fiduciary
without
doesn't
them
know,
knowing. Yeah,
absolutely, Kate. And if the
yeah,
fiduciary doesn't know, you better
yeah.
believe the individual participant doesn't know.
I wonder how many 338s would allow this to happen in a plan if they were, they're responsible for the selection, and monitoring and replacement. I'm I almost want to do a survey about that.
But what do
How
we
many
know
of them would
today
allow it?
about what do we know today about the answer to your question? And doesn't that give us an indication of what their preferences are going forward? I mean, this whole effort is so much supply pressure driven that
Hmm.
as I
It's totally
say,
supply pressure.
uh, so I think that would give us an indication going forward, unless they start using other political pressures to do what they want to do, which
Well,
we've seen in other places.
here's my long-term benchmark from when I was a young whippersnapper congressional staff person.
Uh-oh, what happened now?